the right stock at the right time.
Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks which are buzzing in trade. I am Agam Vakil. Let's welcome in our experts then. We have Mr. T.S. Harihar of HRBV Client Solutions, Chintan Vora of Finance.com, and Sameer Kalra of Target Investing will join us on the show. Thanks for joining us, guys. And today on Hot Money, we will discuss India Cement, Bajaj Electricals, HUL and Sobha. Starting off with the first stock within our list, that is India Cement, and let's ask our experts if the stock can catch up with its peers in the cement industry. And what we've noticed is that the stock is very highly rated even on the Bloomberg consensus. So Chintan, I'm going to start off with you. You're positive on the stock?
Okay. So currently, to answer the question very straight, we are not very positive on the stock. We are neutral on the stock.
Right.
And if you look at this stock, entirely, the volumes have really been, it stands still. They've been very muted. The revenues have not been seeing a spike up. When I look at the overall margins onto this particular stock, it's actually deteriorated to quite an extent. The profit has come down by close to 54%, primarily because of a very good reason that they had to restructure their entire debt by closing on the FCBs.
Right.
So we don't see a lot of heat up onto this particular stock, despite it being at a good place, having a good brand name, and the kind of a cost on raw material that they have to spend is exceedingly higher as compared to the peers.
Right.
And now what we will see is, of late, by using the coal that they import from Indonesia, this is a cheaper source of raw material which is going to get used. We will see some kind of a flavor of profitability coming in, but we are still seeing a respite to be a little late.
Okay. Sameer, how about you? What's your view here?
So particularly on India Cements, not too positive. Given what happened in last 2 years, there were a lot of natural disasters in the south area. So that gave up a leg up to the volumes.
Right.
But if you see, the realizations have been coming down drastically. Now that gives a very less place to EBITDA margin to kick up.
Right.
Which is the main factor for any investor in a cement sector to be bullish on a particular stock. So I think that will be negative for them, because South has a certain surplus capacity which is running, and if that runs for next 2 years, I don't see any upbeat on it.
All right. Mr. Harihar, do you agree with these views?
No, broadly, I would agree with both Sameer and Chintan. Surplus capacity continues to be the big issue as far as South is concerned. So, and the kind of price traction that you saw about a couple of years back, I think that traction is not going to exist any longer. So, if you look at India Cements, I think it started about 60, 65 and went all the way to about 200 or not. So, I think whatever are the immediate upsides on the stock more or less seem to be priced in, and I think the margin of safety at these levels appears to be very limited. So even we are not very positive. Honestly, if you talk about cement, we still think that UltraTech is a much better bet at this point.
All right. So because we have a consensus, well, it doesn't stand for too much debating, but I do want to address the positives, because there has to be a reason behind a lot of these broking houses which are rating the stock very highly. That said, Chintan, what are the opportunities? What would you like to see change in India Cement on an immediate basis that could change your stance in this particular counter?
See, there are some positives which have already kicked in. So, for example, the ban of High Court on pulling off sand. Right. That's one of the positives which has already come in. Moreover, the cost that they have to incur. I mean, the margins are under pressure only for one primary reason: the costs are very high. Right, the locations are a little offbeat, though they are strategically placed in southern part of India, and moreover, they've already done away with their debt restructuring by paying off their closing on the FCBs. So when all these pieces we put it together, we see that there is some spike up in the prices coming in, but still, despite this fall of the stock of this particular stock for last one whole year, we are not seeing any great uptick. Despite this, the stock is still trading at 45 kind of a PE. So we feel that yes, there is some positives which will come in, but as I say that it will take at least another 2 quarters for us to see the reform in the stock prices.
Okay, fair enough. So there you have it. Well, not necessarily positive views coming in on India Cement, and with that, we move across to the second stock. Well, that is Bajaj Electricals. Now, it has hit a record high, and the company has bagged a substantial amount of orders. And this is not in its consumer-facing segment. This is large. It's larger projects as well, and this is which faces the capital goods industry. Let's ask our experts whether they believe in this particular rally and if it is expected to continue. Gentlemen, we have a minute for initial comments. So, Mr. Harihar, I'm going to start with you. What's your view here?
So we like the stock, I think, couple of reasons. Number one, if you look at the IIP numbers in the last couple of months, I think the one signal that seems to be coming is that the capital goods industry seems to be seeing a gradual turnaround. Now, whether it will sustain or not is something we're not too sure.
Right.
But at least there is some room, I would say, green shoots of recovery we are seeing, and that could be a positive as far as Bajaj is concerned. The second, and I think the bigger positive that we see, is that the electrical goods industry used to be largely an unorganized industry. And the big shift that we have all been fighting for is, if GST comes in, then there should be a greater shift towards the organized rather. So I think Bajaj Electricals, other than companies like Havels, should be the big beneficiary of these trends. So putting both of these things together, we believe that Bajaj Electricals could be a long-term play. Not only on the revival in the capital goods sector, but also in the shift to GST.
All right. What about you, Sameer? Do you agree?
So I'm not that positive on Bajaj Electricals, but I think the rally and the sustainability of this rally will be there.
Okay, fair
because
enough.
If you see, the December and the March quarter are the strongest quarters for them, given on the E&P execution, which happens much more drastically on the December and March.
Right.
This new order which they've got from the UP government helps them sustainability of the E&P order book for next 15 months. So that execution will give that revenue growth and the PAT growth which should come out. But on the valuations, I think I'm much more inclined towards Havels, because over there the consumer growth is much more higher now. Right. And their focus now is much more on the consumer growth, and the Lloyd's acquisitions, I think, will play off better off in these 2 summers.
All right. Okay, so the preference here is towards Havels. Chintan, how about you? How are you viewing Bajaj Electricals?
This is certainly a very strong player in the space. It has always been. So our view is, really looking forward to this counter for another few quarters, for a longer term. So it's a long-term play. We bullish onto it for a simple factor that 3,500 plus kind of an order book, order that they've just received, the revenues are expected to realize over a period of time. Moreover, a very strong focus both on customer-centric durables which they have got in, and the order which they've bagged in will make them strong in terms of footprints both in rural and urban areas. So this counter is actually witnessing a lot of sea change in terms of being customer-centric and getting that footprints into both rural and urban areas at the same time. So we see a lot of it which is still left, despite the stock being up by almost 8% in the early trades yesterday.
Okay. All right. Sameer, you did talk about valuations on the stock. With the prospects and with the order flows that are coming in, do you not think that it could change the valuation picture, or are you saying that you want to wait before they start realizing monies from the projects, and then eventually you could change your stance on this?
See, what happens when you go for bigger projects, your working capital issues also creep up. Because what happens, your higher dependence on generating revenue through a particular project goes higher.
Right.
And you might be able to book revenues at a good amount of space, but the cash flow generation of that order might be slower than what there was there. So I would like the focus right now to be on consumer durables, which is much more shorter working capital cycle.
Right.
Get into a major part of it, and then you can use that cash flow to help this kind of a project. But when you have a certain kind of a leg up and already you're beating up, I think then consumer durables is also a very highly competitive, and your E&P becomes also highly working capital cycle.
Right.
So I think both will deteriorate your book or the working capital cycle more rather than anticipated.
Okay, so some concerns coming in with respect to the working capital. And of course, we continue to keep an eye on how Bajaj Electrical pans out, in general in trade, with the way we're starting to see a build-up in its order book. And with that, we'll move on to the third stock on our radar, and that's Hindustan Unilever. The question really I'm asking this time around is that does it still stand as the #1 player? Well, with respect to the prospects that the company offers, of course, we all know and we have discussed that the company is the most organized, has the deepest distribution channels. It's been around for longer than, well, any of its peers, if not as long. The question really is that where does it stand in terms of valuations too? So Samir, coming down to you and your call on HUL.
So valuations are concerned, right? So
Right.
this is not a point where you start buying new stock, and this is not where you add on it.
Right.
Maybe a dip or a fall because of certain anticipation and the estimation mismatch that can be utilized. If you see the distribution, what you talked about, the highest distribution, but what has worked for them in last 2 years is making that distribution from an indirect to direct.
Right.
So in direct distribution, they are able to place more of their goods on the counter, on the shelf, and that's what's driven the volume growth.
Right.
And the second has been the detergents were highly competitive due to PNG and other competition kicking in. That has subsided in the price cutting wars, and the volumes have picked up over there drastically.
Right.
So I think I'm optimistic on the stock, but I would like a dip to come before I buy.
Okay, Mr. Harihar, how about you?
We are extremely optimistic. In fact, Hindustan Lever remains our biggest pick in India across all sectors, and a couple of reasons for that. Number one, if you go to Bloomberg and open the 20-year price chart of Hindustan Unilever, you'll realize that the annual return on Hindustan Unilever over the last 20 years, excluding dividends, is about 2.5%,
Sure.
which is less than what you would have got in a savings bank account. So,
Right.
if you look at it from PE terms, yes. But if you look at it, Hindustan Unilever versus the India consumer growth story, it's nothing. So I think we have probably just scratched the surface. There is a big value underneath, I think, which we are yet to extract. If you look at the growth in rural consumption, which is expected, if you look at growth in urban consumption, with the HRA payouts which are going to happen during this year, I would believe that Hindustan Unilever has probably just about started a massive rally. What about valuations? There is something like what we call the Mona Lisa syndrome that applies to a lot of these FMCG stocks. It's very hard to say whether 40 is expensive, 40 is cheap, or 80 is expensive, or 80 is cheap.
Right.
And I would believe that as long as they represent the essential India consumer story, I would probably still go and buy Hindustan Unilever.
Okay, and what about you, Chintan? You're also positive.
So, I would not concur on most of the points that both the gentlemen spoke about, but we're not extremely positive.
Yeah.
We're neutral to positive onto this particular counter. The reason being very simple. This counter has been, we don't call it to be a very volatile kind of a counter, but for last 2 quarters, the core demand, where the stock actually pulls in a lot of business and volumes, has been from the rural sector,
Right.
which is muted for quite some time now. For last 5 years, if you look at the kind of a growth, the growth is subdued at something less than 8%, though the ROI still stands at 80%. But with this subdued kind of a growth and the ROE still being strong,
Right.
It has become really a big giant which will require a better, bigger muscle to pull itself up from the current levels. So at this point in time, the valuation seems to be little on the expensive side. We don't suggest that we should stay away from the counter, but buying at dips could be a better strategy for us.
Mr. Harihar, these are valid points. Would you like to address some of the points that he's made?
No, I think almost all the points he made are absolutely right.
Yeah.
The only point I was trying to make is 2 things. One is we are looking at the rural consumption in the last 2 years, and we all know that it got badly hit because of demonetization. I think hopefully that is getting over, and the kind of outlays that the government has made to rural spending in the last 2 budgets, and add that on the urban side. We have had the pay commission, we have had the OROP for the army, and then we have had the HRA payouts coming this year. I would believe there's a big impact we're going to see on consumption. And again, I still believe that we thought the India consumption story will start in 1995, but I think it is starting in 2016, 2017. So I think we are sitting on the cusp of something very big.
All right, Samir, my question really is that you've spoken that valuations are a concern for Hindustan Unilever. In that case, what else would you choose in this sector?
So I think an ITC is a very underplayed kind of a FMCG talk. Everyone gives it overweight when it comes to cigarettes business, right? And overestimate the risk over there. But they have to imagine that this is the only other FMCG which has that kind of cash flow generating to pull it through and gain market shares in whatever segments they have tried to play in. And they have been corrective in their ways in reducing the personal care and not entering that area into that much aggressiveness. So ITC is, I think, and now they've shown a bit of positive results. So I think in next couple of years, people will start realizing the importance of the FMCG investment which they have done, and it'll show a good kind of a valuation coming up.
Samir, I'd like to argue there that, you know, with respect to ITC's EBIT, I'm talking about the FMCG segment, ex-cigarettes, they have been wobbly, of course, but that's because they've been putting investments right now, and eventually you'll start seeing profitability. At what point in time can they generate the kind of cash flows from FMCG that could pip the substantial, the massive profits that are coming from the cigarette segment?
See, the only point is it's like talking whether Reliance will give up on oil and gas and just focus on Jio. That'll never happen, because see, cigarettes is their majority market share. Their majority cash flow. Now the only point is who has that other money to fight in that kind of categories. And it's going very dismal as per as the competition is coming in. Now my only point is, if they turn out in next quarter, they have something in the mind, that's why they're showing now a bit positive. That whether it's 200 or 400 crores kind of a bit, that's a different story. But the only point is, tomorrow if they want to stop the investments, it can very well drastically turn out to be a very big player. But right now I think they're still using that cash flow, because see, eventually as an investor, I want to see how that cash flow of the company is being utilized. And I see ITC giving me a good CAGR over the years when there's over that cash flow.
All right, so we have digressed to a certain extent, but of course coming down to HUL, well, largely, should I say, neutral to positive views coming in, and the largest perhaps concern would be the valuations to a certain extent, but that's always been the case for HUL. So we'll move on to the final stock and we'll shift focus to the real estate space now, and we are addressing Sobha, because what we've really seen is, well, management commentary, relatively better transparency in comparison to a lot of the other players. The question we are asking is this the good pick to play the realty sector? So, well, starting off with you, Chintan, how about you? Would you agree it is?
So we do not very actively, track this particular counter. Looking at realty sector, the kind of doldrums it has already been through, we find that Sobha Developers happens to be one very stable player which has marked its footprints not only in southern part of India, but the expansion is pan-India basis. The good thing about this particular counter is a very good governance, internal governance, and a timely delivery of the projects. So overall, looking at this particular piece, the kind of an expansion and running on a very low debt, this company seems to be a good counter for us, and we tend to be bullish onto this particular counter.
All right, your view, Samir?
So I'm not that optimistic on Sobha. They are good as a developer. They have been good as a performer to an investor. But what I see is when you have even a 1:1 kind of a debt to equity, and when you try to explore new territories in real estate, it takes a lot of further investments and further working capital cycle issues into system, because real estate is very geographical system until and unless you play something like a Godrej which ties up with the landowners and goes that model. But if you're trying to do a lot of things at a leveraged book, I see a lot of risk, especially when you go into areas of Middle East and where you try to push a new project over there. So I think there's a lot of risk involved on the downside.
Would you agree that there is a lot of risk involved for Sobha, Mr. Harihar?
See, again, we like the business model. We probably don't like the price, and especially if you look at the fact that the stock is up about 60% in the last 1 year. So we have a couple of worries on Sobha, because we always believed that in the real estate business, it is the commercial real estate business that is monetizable. The retail real estate business is not monetizable. So if you look at an India Bulls, if you look at a DLF, they've been able to monetize the commercial business, not the retail business. Sobha doesn't really have a commercial I would say franchise to talk about,
Right.
worth talking about. They have been largely a retail player. The only advantage of Sobha has been that RERA acceptance has been better in the south, number one. Number two, the offtake of, or rather the empty properties in south have been much lower than probably a Mumbai, Pune or the NCR regions. That is the advantage as far as Sobha is concerned. But we do believe that at these prices, at 547, I would believe that probably all the short-term positives appear to be on the stock. So we are not biased at these levels. Probably lower levels, yes, but not at these prices.
Okay, so well, Chintan, the two questions here basically are: first is the risks that Sobha is taking entering several other markets, and secondly, of course, is positive the prices, the share prices, and the valuations. Can you respond to these?
Okay. Certainly not on the valuations part, because as I said, we do not, very actively trade. But talking about the very first question that you asked, that it entering a new geographies.
Right.
So typically for any real estate, when they enter a new geography, at a book which is very healthy, there are very likely other chances that the books might get deteriorated with, more of a burden onto them, and a lot of capex that will get involved initially. In southern part of India, it's been, very smooth for most of the real estate players to come, make their footprints and, do with the projects on a timely basis.
Right.
So is not the case when you study the data for another part of India, even for that matter for western parts of India, including places like Rajasthan, Gujarat, and Maharashtra. It becomes a little difficult to enter the new geographies. And other fact that there are already other major players which are present in this particular geography, it becomes really difficult for them to acquire a land for a particular project, deploying a lot of capital and encash it right in time.
Right.
So it's a new law, new policies which they have to face. This is exactly what has got a potential to deteriorate their books to certain extent and take a hit on the margins that they have otherwise at this point in time.
All right. Well, because we just have a minute left here, Samir, I just want to address the fact that Sobha is a relatively better reputed company in comparison to several others because of its management. If it wasn't Sobha, which other company would you prefer, only based on the management?
So I would prefer Oberoi.
Okay.
I have a valuation concern right now over there.
Right. Yeah.
But we've been invested in Oberoi for a couple of years now. So I think Oberoi is a better play. I understand that Mumbai real estate market is facing kind of a residential issues and everything. But I think Oberoi has the capability and the management to pull it through without any additional debt or really deteriorating your residential book to come out of.
Right.
So I think Oberoi is my pick.
Right. There you have it, guys. Pros and cons for Sobha, and of course we also discussed several other both positive and negative trends, should I say, for this particular counter. And with that, I'd like to thank our experts here, Mr. Harihar, Samir and Chintan, for joining us and taking us through their views here. But we'll move on and we'll address Tata Sponge, which has come out with a very, very good set of earnings. In fact, it's reported an over 100% jump in its profit. In fact, 124% to be precise for the quarter gone by. And we have the management joining us to give us an outlook. We have Sanjay Patnaik, the MD of the company, on the phone line with Nikki Mirchandani of Bloomberg Quint, who will take us through this conversation. So, Nikki, it's over to you.
Thank you, Agam. Well, the company indeed has reported good set of numbers. Not just a 124% jump that we've seen on bottom line, but then the EBITDA has also shot up 124. On this note, let's get our Managing Director of Tata Sponge in, Sanjay Patnaik. Hello and welcome to Bloomberg Quint. So the first question that I have is, in terms of the operational performance of the company, what explains the modest 28% growth in EBITDA on sequential basis as compared to a 139 growth that we've seen on year-on-year basis? Are we witnessing some kind of cost pressures?
FY18 has really been an excellent year, and as you are mentioning that it has been a very impressive performance on all counts. The volume growth has been about 7%. Tata Sponge probably would be one of the few companies which has registered a capacity utilization of 107% in coal-based DRI, whereas the industry average for coal-based sponge iron is 60%, and Tata Sponge is 107% capacity utilization. We have produced 417,000. Then in terms of the realization, year on year, there has been an increase of 40%. Last year has been, the average NR has been very good, and quarter 4 has been excellent. Quarter 4, the NR over quarter 3 was 21% increase, and our maintenance activities was very well planned, and the maintenance cost, the cost reduction drive has all registered low cost. In fact, there has been drop in the cost of maintenance activities, administrative expenses. So considering all this with good NR, good volumes, it has been a good financial set numbers.
Sure, we get that. But then I'd like to understand how sustainable are your margins at the given level that we've seen for FY18. We're seeing a growth of around 23% for this financial year. Are we expect to sustain? Is the company expected to sustain this kind of margin level going forward in the next fiscal?
I expect this to hold or maybe around that figure. My concern this year, I think the net realization could hold, but my concern this year is the raw material prices might go up, not much for iron ore. I expect the coal prices to fluctuate, because last year, if you really see, over FY18, the increase in raw material prices primarily has been from coal. Coal prices had really shot up. But now it is settling down, and you may be knowing that we get most of our coal from South Africa. Our coal mix is about 90 and 10, 90% imported and 10% domestic. So that is an issue which could push up our input costs. The second issue which could pose a big challenge, which is already a big challenge for us, is the logistics problems. Availability of railway wagons is a major issue for us now, and we are not getting adequate number of wagons. We are incurring additional cost for movement of coal by road, and we are sometimes have to cart coal from Gangavaram or Vizag, whereas we are very close to Paradip, because of the availability of wagon problems. So that could be another issue which will push up cost. By and large, the margins would be in that region, and let's see how it goes. But I am quite hopeful, because the manufacturing sector is picking up. FY19 forecast is good. So hopefully things will work out.
Talking about your raw material prices, since you said that you import 90% of your needs, coal needs from South Africa, I'd like to understand the NSR prices for FY18 and also the outlook of these prices going forward in the next financial year.
This financial year, the coal prices has already, it's around $110, 111, and it keeps fluctuating. 105, it keeps fluctuating. Coming year, that is a bit of a volatility there, and iron ore, I don't think there will be substantial.
All right, that was the management of the company sounding pretty much bullish on the volume growth, however sees some kind of input pressure which could weigh in on the margins of the company though. But with that, it's right on hot money. Do stay tuned into Bloomberg Quint for more.